All right, buckle up because BlackRock just dropped its quarter two earnings. And if you only glanced at the headlines, you would think something was seriously wrong. Their earning per share down a jarring 13% this quarter? No, unbelievable. But here is where it gets wild. In the exact same 3 months, BlackRock shattered records. They hit an astonishing $15.3 trillion in assets under management, pulled in a record breaking first half of new money, and boosted their fattest profit margin in nearly 5 years. So, how on earth does a financial titan have one of its absolute best quarters ever and still report falling earnings? That, my friends, is the mind bending paradox we are unrevealing today. I'm Vikas, your host, and this is what changed from Wing. We don't just chase headlines, we dissect the data to reveal what truly changed. Let's cut through the noise with our signature headline scorecard. Here is the snapshot. BlackRock's GAAP earning per share plummeted to $12.19, a steep drop from 1406 last quarter. This was the headline. But in reality, their adjusted earning per share, the number that actually reflects the health of the business, actually soared to 1391. Yes, it is 1391. That's up 11% for the quarter and a solid 15% from a year ago. So, that reported decline, it's nothing more than an accounting illusion. The real business, it was quietly crushing it, delivering one of its strongest quarter in years. Now, for the core insight, the absolute anchor that will make everything else click into place. Get ready for this. Imagine, if you will, a thermometer, but not just any thermometer. This one reads the room temperature backwards. When the room gets colder, it shows a higher number. When the room warms up, it shows a lower number. If you relied solely on this bizarre device, you would think the room was going the exact opposite of what it actually was. BlackRock, believe it or not, has a line on its income statement that behaves exactly like that backward thermometer. And understanding it is key to unlocking this quarter's mystery. Hold on to that image. Let me set the stage. Over the past 2 years, BlackRock has been on an acquisition spree, snapping up major players like a giant infrastructure manager, a data powerhouse called Preqin, and crucially, a private credit firm known as HPS. When you make deals of this magnitude, part of the purchase price often includes an earnout, a promise to pay more down the line if specific targets are met. Accounting rules demand that you carry this future promise on your books as a liability, and you have to remeasure it every single quarter. Here is the fascinating twist. BlackRock's specific earnouts are tied directly to BlackRock's own share price. So, every quarter, the accountants adjust the liability up or down based on how BlackRock's stock performed. And it works backwards, just like our thermometer. When BlackRock's stock dips, the liability shrinks and the company books again, making reported profit look higher. But when the stock surges, the liability grows and they book an expense dragging report profit down. Now, watch how this played out. Last quarter, this quirky line produced a massive $549 million gain. That gain artificially inflated the GAAP earnings and the numbers to $14.06, which ironically was higher than the adjusted number that quarter. But this quarter, the line flipped to a small expense. There was no gain to prop up the numbers. So GAAP earnings per share appeared to fall to 12.19. But here is the truth. Nothing happened to the core business. The backward thermometer just swung the other way. This is precisely why BlackRock, like any serious player, also reports an adjusted number that strips out all the accounting noise. And that adjusted number tells a phenomenal story. Adjusted earning per share jumped 11% from last quarter and 15% from a year ago. The two numbers, GAAP and adjusted, literally crossed paths between the two quarters. Last quarter, GAAP was on top. This quarter, adjusted is king. It's the exact same company with no change in the engine, just a different reading on the thermometer. So, the next time you see a headline screaming that BlackRock's earning dropped, remember the backwards thermometer. Look at the adjusted line and look at the actual business. Now, let me tell you, when you look past the optics, the business is genuinely robust. Though I do have one honest asterisk to share in a moment. Let's start with the lifeblood of any asset manager, flows. New client money poured in to the tune of $192 billion this quarter. Yes, this is $192 billion this quarter. That fueled a record first half of 321 billion and a staggering 868 billion over the last 12 months. Total assets, a record shattering 15.3 trillion. And their technology platform, oh, it's Aladdin. It just keeps compounding with its forward revenue measure growth, a solid 15%. But here is the metric that truly matters, the one that separates the wheat from the chaff. It's called organic base fees growth, and it hit 8%. Let me translate why this is the single most important number for a behemoth like BlackRock. Not all incoming money is created equal. Some of it is cheap, that is index money that barely generates a fee. But some of it is high value, active, and private market money that pays real and substantial fees. Organic base fee growth, that is, measure the flows weighted by the fees they actually earn. So when BlackRock grows base fees by 8% from new business alone, that is the real engine roaring to life. And 8% is exceptional, well above their own targets. This is also why you should not panic over one seemingly scary line in the floor table. The institutional index business saw outflow of $41 billion. Read that in isolation, and it looks like a mass exodus. But that's the cheapest, lumpiest money in the entire firm. Massive pension funds simply shifting mandates around. It barely makes a dent in revenue. Meanwhile, the fee rich buckets, active management, private credit, infrastructure were strongly positive. The headline flow numbers and the fee number can point in completely different direction. And the fee number is the one that actually pays the bill. And the margin, it proves that their massive scale is finally paying off. Adjusted operating margin hit 45.9%, the highest in nearly 5 years. For years, all those acquisitions diluted the margin while BlackRock digested them. Now, the platform is translating that sheer size into actual. tangible profitability, not just a bigger pile of assets. Now, for that honest asterisk, the bias flag I promised to raise, because it's the one trap these record numbers can lure you into. Of the roughly $2.8 trillion of assets growth over the past year, about 2 trillion of it is simply market appreciation. Stocks and bonds went up, so the assets BlackRock manages are worth more and the fees on them rise accordingly. That's real money, yes, but it's borrowed from the market. If markets stumble, that piece reverse. The durable growth is the flows and the fees growth. So don't mistake a bull market record for a permanent floor. So where does this level comes into our assessment? Coming out of last quarter, our implied read on BlackRock was 7.4 out of 10. Today, that edges up to the 7.6 out of 10. It rises because the franchisee is genuinely compounding, a record fee, rich flows, a 5 year high margin, and a strategic pivot toward private markets and technology that is now undeniably showing up in the numbers. But it does not rise higher than that because a lot of this good news is already baked into the price. The record assets lean partially on the market's performance, and per share growth is slightly diluted by the shares issued for the HPS deal. And the current valuation already assumes this durable double digit growth will continue uninterrupted. Again, this is not a buy or sell recommendation. It is simply our rigorous assessment of how much confidence today's evidence truly deserves. Here are three critical questions the next quarter must answer. Number one, does this organic base fees growth hold near double digits? 8% when we are talking about this quarter, 10% over the last quarter. That is the cleanest read on the franchise health. Watch closely whether it stays strong or drifts back toward their baseline target. Number two, does private credit scale? The HPS deal is their massive strategic bet. Watch the fees from private markets grow as it fully integrates. That is the durability thesis encapsulated in a single line. Number three, does the buyback offset the dilution? Well, BlackRock just upped its planned repurchases. Watch whether that aggressive move pulls per share growth back up to match the operative growth. So, the real story today is not a falling earnings numbers. It's a record breaking quarter hiding behind a backwards accounting line. Record assets, record flows, and the absolute best margin we have seen in the years. If you want to dive deep into every source and every calculation behind today's analysis, you will find the complete, unvarnished research report at vyng.io. Everything is sourced directly from BlackRock's official filings because trust is not built by confidence, it's built by transparency. I'm Vikas. This has been What Changed from Wing, clarity, not clutter.